China has been systematically decreasing, I should say, its holdings of US Treasuries. It is very consequential and it is very important. In July, the latest data available, Beijing's foreign exchange reserves fell to $730 billion, which is $26 billion less than the month prior to that in June. According to Chinese financial data provider Wind, the July figure was the lowest since January of 2009, and on top of that, it is 45% lower than the record high of $1.3 trillion recorded in November of 2013. South China Morning Post recently shared the reduction in U.S. Treasury holdings in the PRC's portfolio comes amid growing warnings from Chinese economists about the weaponization of the U.S. dollar against the backdrop of rising tensions between the two superpowers, as well as persistent concerns over the sustainability of U.S. government debt. It is not yet clear what exactly the People's Bank of China is choosing instead of the dollar, but we do know that China is actively buying gold, further reducing its dependence not only on the dollar but also on fiat currencies in general. In addition to that, there is speculation that Beijing is increasing its holdings of euros, British pounds, and Swiss francs. The logic behind this is very clear. Reducing the share of U.S. Treasuries decreases China's dependence on American monetary policy, and it lowers the risk of asset freeze, as happened with Russia's reserves back in 2022. Increasing investments in euros and European bonds seems reasonable too. The EU remains China's largest trading partner, and exports to Europe are growing despite Brussels' efforts. At the same time, the risk of financial sanctions from Europe is significantly lower than from the United States, despite the fact that, of course, those risks do exist. The same goes for the British pound. Despite Brexit, the UK remains a key partner for China in finance and in technology. As for the Swiss franc, it typically retains its value during most geopolitical crises due to its relative insulation from US and EU political influence. So these are unfavorable developments, of course, for the United States. A decline in external demand for treasuries could lead to higher borrowing costs. And the United States debt burden is already at a record high, around $37 trillion and counting. More importantly, this is not a one-time tactic of China dumping dollars, but a strategic shift. It is going to continue, and countries are going to join. Countries are going to do the same the more unstable the situation becomes in terms of geopolitics. The gradual reduction of dependence on American assets leads to an erosion of dollar hegemony, though of course it doesn't break it overnight. The majority of global reserves are still denominated in US dollars. Over the next 5 to 10 years, analysts do expect even further rebalancing on the global scale. The dollar will likely remain relatively dominant, but its share will shrink further and further, while the euro-yuan gold basket will gain strength. In general, investor demand for U.S. Treasuries has been declining, and it is a big concern. It should be a concern for Washington. We don't hear a lot about it. Here's what Wall Street Journal reported following a recent U.S. Treasuries auction, and this sounds really bad. A Treasury sell-off intensifies, writes Wall Street Journal, sending yields higher. Demand in a 30-year auction declined, fueling concerns sparked by yesterday's lukewarm reception of 10-year notes. So both 10-year and 30-year notes were not really received very well. Markets fear investors may be growing reluctant to finance, attention, the U.S. budget. Meanwhile, jobless claims increase, supporting suspicions that the labor market could be cooling fast. And of course, the labor market is quite literally collapsing. I just covered the most recent report last week. If you look at this illustration here, you will notice that foreign investors' demand for 30-year US Treasuries, for long-term US Treasuries, it has been declining, and not just declining, it is tanking. It's now at an all-time low. Demand for Treasuries is critical. The Treasury relies on approximately 300 auctions per year across bills, notes, floating rate notes, bonds, and Treasury inflation-protected securities to fund the federal deficit. So they rely on these auctions to continue funding deficits because they do operate at deficits. They're just kicking that can down the road. Besides demand, there are three other indicators that we need to look at, such as bid to cover ratio, tail, which reflects issued yield versus auction yield, and the third one is primary dealer allocation. I won't be getting into those technical details in this video, but if you're interested, let me know in the comments and I will in the next video. At roughly $29 trillion, the US Treasury market is the largest, most liquid debt market in the entire world. Those qualities help make it a tame corner for the bond market most of the time. However, at times recently, it's been anything but tame.